Another option out there to offset this capital gain that you have is a qualified opportunity fund or an opportunity zone deal. So here's where this came about. In the Tax Cuts and Jobs Act of 2017, it set the stage for these opportunity zone deals. The government wanted to funnel money into less disadvantaged areas. And if you Google opportunity zones maps, you can see where these areas are. And if you're like me, you're gonna have the hair stick up in the back of your neck, and a lot of these areas are pretty grungy. But that's exactly where the government wanted the money to go. So it makes sense. We say, don't let the tax tail wag the dog. Personally, I like to invest in better areas as opposed to garbage areas that are opportunity zones. Now, I'm not saying that all opportunity zone areas are garbage areas, but they're definitely more transitory and transitioning, and they may not be a good investment in the long run. So, by doing these types of investments, you're able to get a lot of tax benefits, and it's very confusing out there. And quite honestly, not a lot of CPAs even understand the tax law here because a lot of it is really untested because it's such a new thing. The tax benefits here can be really amazing. Now, it really depends on when you enter in one of these deals, and you have to hold on to these investments for over 10 years to get the full effect. Imagine you throwing $250,000 and it blooms to $2 million dollars in a decade. No tax on that growth because you invested in, again, I'll insert risky opportunity zone area. Now, if you're going to go down this road, make sure you get a good CPA to sign off on all the stuff that you're doing here. Now, I'm not going to get it bogged down in the details. Essentially, you can put your money into one of these qualified opportunity zone areas and offset all your taxes. A lot of these locations are a little bit suspicious. There's a lot of case law that hasn't been developed around this, so be careful. My own comments, just from an investor perspective, is I don't like to invest in these transitioning garbage areas. Sure, maybe a lot of money is going in there, but we never know. And I don't like to hold on to an asset more than 5 to 10 years anyway, especially if it's a commercial asset. Commercial assets just get old and decay over time, right? Today, we don't really want to get into assets that are 1970s and older because they're just functioning obsolete. They attract worse tenants and just stuff breaks all the time. It's hard to figure out what's going to break and it's so variable. We prefer just newer assets these days to take out the variability of ownership. So if you're seeing it my way, you don't want to be in an asset for very long. Now, you may see this as more of a transitory type of viewpoint on investing. I just like to get in, bump the value of the property, and get the heck out. Once I've bumped the value of the property through renovations, improving of the management team and the processes, really, we've bumped it up here, and that property is only going to go down over time. In a way, go out at top, right? Like a LeBron James or Tom Brady. It's always best that they go out on top. Nobody likes to see their superstar ride the bench in the sunset years of their career. And in your case of owning real estate, you don't want to be paying for all these little things that are going to be coming up once a property starts to get old and decayed and the deferred maintenance wave starts to hit you. And if you follow my book, The Wealth Elevator, and if you want a free copy, at least check out the pull-out page of the chart. As your net worth rises, certainly above $3, $4 million net worth, you're going to start to realize that you want to get out of direct ownership of real estate and either in a passive LP position or possibly even getting out of alternative investments to begin with. Today, we'll implement the infinite banking, accredited investor banking, and get a pretty much risk free 4 to 5% return there. That's also tax free. Those types of returns may not get you excited, but after a certain point, once you hit $4 to $5 million net worth, you've hit this threshold of the third floor penthouse level of the wealth elevator. And your prospects of investing sort of change. And time is more important to you at that point than to dealing with the headaches and the liability of direct ownership of properties. Personally, direct ownership in real estate is what got me to where I'm at today. I had 11 rental properties back in 2015, started to trade that for larger syndications and private placements from there. But as I start to personally mature, my net worth gets even higher. I see the whole idea of trading in top dollar returns for less headaches and liability. That said, it really depends on where you are in the wealth building journey. If you're on the first or the second floor of the wealth elevator under a few $1 million net worth, you're still going to need alternative investments. Fast forward 5 to 10 years, you're going to be moving up to that next floor of the wealth elevator. And again, time and peace of mind and less brain damage is going to be at the forefront as opposed to getting 15, 20, 25% returns a year.